Hi, everybody. My name is Matthew Owens. I am a California licensed CPA and a full-time real estate investor. I am here today with Karen Hall. She is the owner of UDirect IRA Services. She is or UDirect IRA. She helps investors invest with their self-directed retirement accounts and is a custodian for those IRAs. I am a full-time investor myself. I flip houses as well as work with different investors on in multiple ways. And tonight we're going to be talking a little bit about securing your future, investing in real estate through your self-directed IRA. I invest substantially in real estate with my self-directed 401k and IRA and HSA, and it's a great strategy to utilize to build those returns without having to pay tax on those returns. That being said, I'm going to go ahead and turn over the beginning portion of the presentation over to Karen so that she can teach you a little bit about how to invest in an IRA through real estate and some of the strategies that exist and some of the benefits as well as some of the cons involved too. So Karen, I'm going to go ahead and change the presenter here.
Sounds good.
Find your name.
There we go. It's the one with two A's.
There we go.
Okay.
There you go.
All right. Well, let's talk about self-directed IRAs then. Let's do that. All right, from the beginning. Here we go. Thanks so much, Matt, for letting me be a guest on your webinar today. I appreciate it. And so my name's Karen. I'm the CEO of UDirect IRA Services. And what we do is we help you take your retirement dollars from where they are and move them into a self-directed IRA, which is going to allow you to invest in many, many, many more asset classes than you can presently invest in with your retirement account. So what we do is help you, self-direct your IRA, but what we don't do is give you tax and legal advice. Matt is a CPA. You can ask him for tax advice. Go to your lawyer for legal advice. And we're not going to tell you which asset to invest in. We don't endorse any particular assets, but we do give you the opportunity to use a self-directed IRA and use that to invest in the kind of assets that you best understand. So when it comes to IRAs, they are all about saving for later. And believe me, later is going to happen sooner than you think. There's right now about a $6.6 trillion deficit between what Americans have and what is needed to retire, a big deficit. And it's growing even further when we consider pensions are underfunded and Social Security is, on the brink. And so the point is, we have to take responsibility for our own retirement. I know Matt is going to talk about this too, with some solutions. And so if you had $100,000 in a retirement account right now, you'd be about average. For those who've saved, about $100,000 is pretty much average. So say you're 59 and a half. And you're going to live until you're 86 and a half. Now, assuming no gain or loss, just for the sake of, conversation, if you were going to live on that over, that lifespan, that would mean you would have only just under $400 a month to live on. So it's just not enough. We all have got to seriously focus on retirement and saving for it. So that's what self-directed IRAs can help you do. When you talk about the total pool of retirement funds in America, they break down into these different categories. About $24 trillion is in retirement funds, and only about 3-4% of it is in alternative assets. So if you're looking to raise capital for your deals, IRAs are a great source of capital. If you're looking to partner with someone on your deal, you can ask someone, hey, do you have an IRA? Or do you have a 401k with your previous employer? And if the answer is yes, then you can partner with that person's retirement money to invest. So there's a lot of money in retirement accounts in America, which, but not enough, not nearly enough. Now, Tom Perez is no longer the Department of Labor Secretary. He's got a different job, but he has a really good point. And he says, we've moved from the era of defined benefit plans to kind of a modern family universe of IRAs and 401ks. And he says the responsibility for retirement savings is squarely in the hands of ordinary Americans. That's me, that's you, that's all of us. We've got to take care of this and be responsible. So how are we going to do that? And that's what we're going to talk about tonight. If you have not heard about self-directing your IRA, don't feel like you've missed out or you're not in the know or something, because a lot of people do not know about self-directed IRAs. In fact, self-directed IRAs are not even well known to let's go back here a little bit. They're not even well known to CPAs and attorneys who talk about this. I've had people call me and say, yeah, my CPA said that I can't invest in real estate using my IRA. And that's just crazy because these rules that allow you to self-direct were created when Gerald Ford was president. Ford signed the ERISA laws into effect in 1974. They went to effect in 1975. And so, yeah, 42 years you've been able to self-direct your IRA. It's not something new. It's been around a long time. It's tried and true. So you can feel confident about that. So what is the difference? The difference between a self-directed IRA and your typical IRA is the asset class. So you think about that IRA or solo 401k. It could be a Roth, it could be a SEP IRA, whatever, but you think about those accounts as like a bucket that holds assets. So in a typical IRA, you can only hold stocks, bonds, and mutual funds, CDs, things that are tied to the market, that sort of thing. But with a self-directed IRA, what makes it different is that you can invest in all these alternative asset classes. That's how that works. So the rules are the same for IRAs, the way you contribute, the way you take money out, the penalties, the rules are all the same for both kinds of IRAs. The only difference is the kind of asset your self-directed IRA lets you have. That's the difference, okay? So when you're self-directing your IRA, it's so important, and this is something that Matt has done several events on about doing your due diligence. Matt's really great about this topic. In fact, I'd love to do another event just on due diligence because it's so important. But if your IRA loses money, you're not going to write those losses off on your taxes, and the losses can't be easily replaced in your IRA because the contribution limits are small, especially, in relation to what you may have invested. So you must do your due diligence up front so that you have a good experience. And people have, invested and lost their money in a self-directed IRA. And then what they have to do at that point is go to a third-party evaluator and obtain a valuation to prove that they lost their money. So due diligence is crucial with self-directed IRAs, that you're making a good decision, because losses are more than just losses. You have to prove you lost your money. So what are the limits? All right, a self-directed IRA, when the IRS came up with this idea, they came up with the idea of IRAs and self-directed just as a label that we slapped on them, because the government never delineated between a typical IRA and a self-directed IRA. But when they set up IRAs, they said you can invest your IRA in anything except life insurance contracts and collectibles. That's what they said. All right, that's really leaves everything else open, and that's why there are self-directed IRAs, because you can invest in anything except life insurance and collectibles. And also, one thing, your IRA does not buy shares of an S corporation. Your IRA can loan money to an S corporation, but your IRA doesn't buy shares of an S corp, because S corps don't allow non-human entities to become shareholders. Okay, so those are the limits. Pretty much the sky's the limit, right? So say you want to self-direct. This is a great idea. You think, yeah, this is great. The stock market is doing really, really well now. I don't know how long it's going to go. And, I don't trust the stock market, but I understand real estate. I understand notes. I understand precious metals. I understand some other asset class. And you really want to take that money and put it into a self-directed IRA. Well, if the money is with your current employer, you probably won't be able to move that money until you leave the service of the company. You can go to the company and you can ask them if you can have an in-service transfer. That means you're working there, you're in service, and you just want to move the money over. So sometimes you're allowed to have that in-service transfer, and you can ask. So there is no conversation about self-directed IRAs that would be complete without a discussion about the rules. And Matt, I kind of like to think about self-directed IRAs as like a game. So if I said, hey, we're going to play a game, I mean, I know you, the first thing you're going to say is like, how do I win, right? So you want to win this game. And when it comes to self-directed IRAs, I mean, what you're winning is your retirement. You want to win this game. So let's talk about the rules and the players and how you win the game, and what to watch out for, all right? So the rules can be read first on the IRS's website, irs.gov. irs.gov. Look up publication 590. This year they broke it down into sections A and B, 590A, 590B, but there it is. So it's got all kinds of, you can learn all about IRAs there. And it explains that you don't borrow money from an IRA. Now, you can borrow money from a 401k, a solo 401k you can borrow from, but not an IRA. You don't sell anything you personally own to your IRA. You don't use that IRA as security for a loan, and you're not going to use it to buy property for personal use, present or future. IRA assets are kept at arm's length, all right? Now, more about the rules. With self-directed IRAs, there's kind of this unique rule. I don't know if this exists anywhere else. In the 10 years I've been doing this, I haven't found anywhere else where this applies, but some people are qualified and some people are actually disqualified to the IRA. So those disqualified people, the people your IRA doesn't do business with, are your lineal ascendants and descendants, your parents and grandparents and their spouses, you and your spouse, and then your children and your grandchildren and their spouses, all right? Plus anybody who's a fiduciary to the plan, anybody who's offering services to the plan, a 50% business partner, they are disqualified people, all right? But the people who are allowed and the people who are qualified are the people who are out to the sides on the family tree. And that would be your aunts and uncles and your cousins and your brothers and sisters and nieces and nephews. So if someone says, oh yeah, self-directed IRA, you can't invest with your family, that's not true. It just depends on where that family is on your family tree. Mom and dad, no. Brothers and sisters, yes. You see how that works? You know, your dad, no. Your uncle, yes. That's how it works. So some people are allowed and some people are disallowed to the IRA. Now, the real rules, where it all boils down to, is prohibited transactions. This is the keep away, the game of keep away that we're playing here. You keep away from these prohibited transactions. Neither you nor any of those disqualified people I just mentioned can benefit from the IRA today. It's all about later. It's all about later. So you can't have personal benefit, present benefit, indirect benefit from your IRA. So what does that mean? That means, for example, my favorite example is to talk about this gentleman who was an appraiser, and he came in and he wasn't being an appraiser anymore, so he left the company and he had a 401k to roll over. And he said what he wanted to do is take all that money and lend it to his sister-in-law on a loan. Now, your IRA can lend money to other people. That can happen. And a sister-in-law is one of those allowed people. That's okay. But I thought I'd better ask this gentleman more questions. And I said, okay, well, when your sister-in-law gets the money, what is she going to do with it? He says, oh, well, she's going to invest in my company. So we had to talk about that because it's called, no indirect benefit. The money goes from your IRA to your sister-in-law, that's fine. But then you can't indirectly benefit from your own IRA by having her invest in your company. That would be a prohibited transaction. Then I should add that when your IRA commits a prohibited transaction, you no longer have an IRA. I mean, it doesn't happen instantaneously. The IRS has to, you have to call, they have to call you on it. But your IRA can be dispersed to you as a taxable event, as though there was no IRA, and you may owe taxes and penalties. So you really want to avoid this. Okay, so you keep everything arm's length. Number two, you're not going to buy, sell, or exchange assets between the IRA, between the plan, and any of those disqualified people. So your IRA doesn't buy a house that your dad owns. Your IRA doesn't sell a house to your children. Your IRA does not make a loan so your kids can go to college, because your children are lineal descendants. They're disallowed. Your IRA does not make a loan to help your wife's business. That doesn't happen. We get asked those questions all the time, and that is a prohibited transaction. You don't do it. And number three, one of those disallowed people, well, they can't provide goods, services, or facilities to the plan. And here's what that means. Now, remember, you're disallowed to your IRA too. So your IRA, say, for example, owns a house. And so as a disallowed person, you're not going to go in there and swing the hammers, and you're not going to go in there and change out the garbage disposal. You're not going to do any of that, because it's called an over-contribution of sweat equity, and it's disallowed. So you have to be really careful that you keep at arm's length, hire third-party vendors for the things that need to happen, and make sure that you're very careful. All right. So there's some noise on the other line, so if you could mute, that would be awesome. Hey, so with self-directed IRAs, the structure, that's important too. You want to know, if you're going to play the game, who are the players? So you're a player. Obviously, it's your self-directed IRA, but your IRA is a separate entity. So there's you, and then there's your IRA. And then there's UDirect IRA services. And when I founded this company in 2009, I enlisted the services of a trust company custodian to hold the funds. So these are the players in the self-directed IRA game. Okay, so one of the biggest asset classes that people invest self-directed IRAs in, across the board at all in our entire industry is real estate. So let's talk about that. When you're buying real estate with your IRA, there are pros and cons. Maybe it makes sense for you, maybe it doesn't. So that's part of doing your due diligence, is to determine it. But let me help you here with some of the due diligence. So the pros are that the money that comes back in, the capital gains, the positive cash flow, proceeds from the sale, whatever, come in tax-free in a Roth or tax-deferred in a different kind of account, right? So that's great. You're not paying tax on it immediately. Number two, there's no time limit for holding the property. You buy it, your IRA buys it today, you can sell it tomorrow, and there's no tax ramification. It's in a tax-protected account. Number three, your IRA can actually borrow money. Now, you don't go to your favorite loan officer and say, hey, I'd like to get a conventional conforming loan for my IRA. It's not that kind of loan. And I'll talk about it in a minute. So just know it's not the kind of loan you think it is. And number four here, there is a potential to earn a larger rate of return on your invested capital because, say, for example, your IRA buys a house and a few years go by and you sell it and you make a profit. Here comes that profit right back in your IRA. Well, it's not being diminished by tax, right? So now you can take 100% of those returns and put them out into your next deal so you can compound faster. So that is a really big bonus with using self-directed IRAs. The downside about using self-directed IRAs is that you don't get the same tax advantages that you do if you invested using your personal funds. So when you invest with your personal funds, you can talk to Matt about all the tax deductions, but you get lots of tax deductions for investing in real estate. So if your question is, hey, I've got this much cash and I've got this much IRA money, which one do I want to invest in real estate in? That's one conversation. But if your conversation is, I really don't have investable cash, liquid cash personally, but I have all this retirement money, I don't really want it in the stock market, maybe then you want to look at real estate, right? So you're not going to take a deduction for capital losses. You're not going to, if you go travel to your IRA-owned property, you don't get to write it off on your taxes. Of course, it is self-directed. So you are solely responsible for all gains and losses in that account because you're the one choosing the asset. We don't choose for you. We're administrative and not advisory. You're choosing your assets and we accomplish those tasks, on behalf of your IRA. Now, as I mentioned, you can't replace losses very easily because of contribution limits. So this is the downside and the things you need to think about before you invest in real estate using your self-directed IRA. I did mention your IRA can borrow money, so let's talk about that right now. The kind of loan it is not a conventional conforming Fannie Freddie, there we go, or a VA loan, or it's not an FHA loan. It's none of those consumer loans. It must be a non-recourse loan. And these loans are made by special lenders. If you'd like a list of those lenders, I can email it to you. Just shoot me an email at khall, Khall, at the letter U, udirectira.com. Okay, and I'll send you a list of non-recourse lenders. So when your IRA borrows non-recourse money, that non-recourse lender can only come against the subject property, not against any other assets in the IRA, not against you personally, just the subject property. Now, that's pretty great, and that's a non-recourse loan. That's pretty good. So no, there aren't a lot of lenders to choose from, though, and they are going to require more skin in the game. Typically, your IRA is going to need to come up with 40, 45, 50% of the funds. Of course, everything is based on risk, so you would want to speak to a non-recourse lender to find out their particular loan guidelines, because everything is, every company is different, and you definitely cannot personally guarantee a loan to your IRA, and that's because you're disallowed to the IRA. So you are not going to offer a personal guarantee to your IRA, but like a qualified person, they could guarantee the loan. All right. When your IRA borrows money, your IRA can actually be taxed. All right. And this comes as a surprise to some people, but it really shouldn't, because you need to know the whole picture before you play this game, right? So when your IRA borrows money, it can throw off a tax. The tax is called UDFI. You want to discuss it with your tax advisor. Unrelated debt financed income tax. Now, it doesn't have to be a deal killer. What you do is you just pencil it out. Here are my acquisition costs and, my rehab costs. This is the cost of, this tax I'm going to need to pay. Does it all pencil out in the end? So you begin with the end in mind. You do your due diligence. You pencil it out to begin with, and then decide if having your IRA take on leverage makes sense. Now, So again, your IRA is taxed when it borrows non-recourse money. If it doesn't borrow non-recourse money, well, it's pretty much not going to be taxed unless you run into the second kind of tax that an IRA could be subject to, and that's called UBIT, unrelated business income tax. If you want to read about these taxes and do some homework, go back to the IRS's website. It's irs.gov, publication 598. Discuss it with your tax advisor. So unrelated business income tax happens when your IRA invests in a business, like an active business, basically. So your IRA can be subject to these taxes, and you definitely don't want to be caught unaware of this. You definitely want to know this going in. Okay, so how does your IRA buy real estate anyway? We all know how we buy a house. We all know how we buy stocks, bonds, and mutual funds, and we go online, we do a couple clicks, or we call our financial advisor, and then we buy stock. But how do you get a house in an IRA? Well, here you go. So first, you want to open the account, the self-directed IRA account, because when you're making offers on property, you want to make sure that there's money to cover it. So you open the IRA. It's going to take your current custodian about 2 weeks to move the money into your self-directed IRA so that you have money to make an offer and make an earnest money deposit. So open the account, get it funded, then shop for a property. Remember, the IRA is the buyer. It's not you personally. You don't sign for your IRA. You don't take constructive use of your IRA. You are not the signature. It's the custodian for the benefit of the IRA. We sign that for you. So the name of the buyer is custodian for the benefit of your IRA. That is the name of the buyer, not your personal name. So you give us a direction letter. You give us the supporting documentation, which is, say, the offer to purchase. We review it, fund it. You fund, you close, you get your keys, it's recorded, and all that happens. And then your tenants make their checks payable to the custodian for the benefit of your IRA. Now, before this webinar, Matt and I were talking about, well, when does it make sense, for the property manager to get involved? Property managers can be a self-directed IRA's best friend. And that's because a property manager helps you to keep the whole transaction arm's length, as we were talking about before, okay? So maybe it's you and you're investing with someone, and if that's the case, your tenants would technically need to write 2 checks for the rent every month, one to the IRA, one to the other party. So better if they make one check payable to the property manager, and the property manager divvies that out. Also, property managers are great because if there are any repairs, you can't do them because remember, you're disallowed and you can't offer any services to the plan. So your property manager can handle things that you're not allowed to do. So here's an example of really something that I told you can't do, but it's a loophole. All right. So we're going to show you an example of a father and a son, one using cash, one using an IRA, buying a house together. So fathers and sons are disallowed to each other, but there's an exception. So dad is bringing in cash. He's coming in 50%. The son is going to use his traditional IRA. So title is going to read the custodian for the benefit of FBO, right? Custodian for the benefit of the son's IRA, 50% owner, the father, 50% owner, tenants in common. That's how that reads. Now, wait a minute, aren't they disqualified? I mean, yeah, they are. So, but if before the deal, the father had no ownership and the son had no ownership and his IRA had no ownership in that property, because it's a new deal, they don't have to worry about that disqualified person rule because it's going to fund concurrently, you see. So everything's going to happen at the same time. It's only after the deal that disqualified person rule comes into effect. So they're never going to sell that asset to each other. Neither one of them is ever going to have any personal use of it. And that's how that works. Okay. So after the deal, they don't buy each other out. And after the deal, all expenses have to be paid for by the IRA. All proceeds must go back in the IRA. But in this case, 50% are going to go to dad, to his own checking account. 50% of the proceeds are going to go to the son's IRA. Similarly, with expenses. Now, when your IRA is a percentage owner, your IRA is, invests a percentage from day one. Say it's like this 50-50. Your IRA pays 50% of the earnest money. Your IRA covers 50% of the closing costs. Your IRA covers 50% of the rehab costs. All the way down the line, it's split pro rata from the beginning to the end. That's how that works. Okay, so I did mention that all expenses of the IRA must be paid for by the IRA. So what if the IRA depletes its reserves? Okay, what if there's no money to make that property tax bill payment when it comes up? What are you going to do? All right, here are 6 things. One, you can write a check and make your annual contribution, which depends upon your age and your income and your account type. So you talk to your tax person and find out, well, hey, how much can I contribute? You could also liquidate other assets in that IRA. So maybe you've got some gold bullion and a house. You liquidate the gold to cash, you sell it, and use that cash to make up the shortfall. You could do that. You could transfer money from another retirement account. Maybe you still have some stocks, bonds, and mutual funds, so you sell those and then transfer the money over to your self-directed IRA and make up the shortfall. You could bring on a partner as long as they weren't disqualified. Your IRA could borrow money, but it would have to be not from a bank or an institution. Probably wouldn't make that kind of loan, probably from an individual. And if all else fails, you can sell the asset if you can't make up for the shortfall. So that's what you do if your IRA runs into a shortfall. Now, many of you may have heard of something called a checkbook IRA, and I believe that Matt described and mentioned it in the promotional, emails and materials for this event. So, a checkbook IRA, it's a terrible misunderstanding word. I mean, people like to use it, but it leads to a lot of misunderstandings. There isn't a checkbook IRA. There isn't a special kind of IRS promulgated IRA that's called a checkbook IRA. This is just a jargon term. And what it really refers to is an IRA-owned LLC. So here's how it works. Your self-directed IRA is open and has money in it. You hire a third party to create a special purpose LLC. Why don't you do it yourself? Because your IRA can't buy an asset that you own. And if you do it yourself, you own that LLC. And so your IRA can never buy it. You really want to get an expert to do this, because it has to be a special purpose LLC, has to have special language in it. So after that is set up, your IRA will then buy 100% of the initial shares of that LLC. So the money goes from your IRA account into the checking account of this special purpose LLC. And that's how you have checkbook authority over your IRA funds. That's how that works. It's not like when you open a self-directed IRA, you don't automatically receive a checkbook. That's a common misunderstanding. It doesn't work that way at all. You have to go through special steps, create a special purpose LLC, and go from there. But of course, with great power comes great responsibility. If you're going to do this and bypass the custodian, that means you don't have a second set of eyes looking at every deal to see if it's a prohibited transaction. So you just have to be real careful with these things, very, very careful, because it's extremely easy to commit a prohibited transaction. Now, if you have an account with us and you've got questions, you can call us and say, hey, I'm thinking about doing this. Does it sound to you like it's prohibited? I mean, we'll have that chat with you, so we can try to steer you clear of prohibited transactions. All right. So when it comes to self-directing, we call it the self-directed IRA, but you can self-direct all these kinds of plans. The self-directed IRA is just a general term, but it's not just a traditional IRA. It's the traditional Roth, SEP simple, spousal, inherited IRAs. We offer the solo K, the individual K, which is a 401k plan for a sole business owner who has no employees, no full-time employees in the company. All right, so, and those have a lot of bells and whistles. You can also self-direct Coverdales, which are educational savings accounts, and health savings accounts. All that can be self-directed. So how do you do it? How do you self-direct? Well, it's really a 3-step process. You open an account, you fund it by either contribution, transfer, or rollover, and after it's open and funded, then you invest. You give us a direction of investment form. That's our form on our website. You give us the supporting documentation, which is the contract. We review and fund your deal, and now you have self-directed your IRA. That's how it works. Now, if you'd like more information, I'd be happy to have a chat with you or send me an email and I'll answer. Email me at khall, Khall, at the letter U, udirectira.com. Go to our website too, because we have a great blog, and Matt has some articles on there. We have all kinds of articles where you can learn more about self-directed IRAs. Pretty much everything you need to know is on our website. Well, we're happy to talk to you, answer your emails, all that. So that's how you get a hold of us right there. And with that, I will turn things back over to Matt. And Matt, hey, thanks so much. I really appreciate being a guest on your webinar today.
No problem at all. That was absolutely an amazing presentation. I feel like it was very high quality. You touched on the important topics that people need to understand. And I think one of the biggest things people have trouble with is understanding how these things work and how to protect yourself if you get into trouble, what things not to do with your IRA and how the paperwork works, to have a full understanding before they get started investing in the first place. And that's one of the I guess the hardest parts, even though it is pretty simple once you really understand it. At the same time, a lot of people don't understand it up front, and then they get themselves into trouble and doing the wrong types of transactions. And so I think it's really extremely important to go through and get that understanding up front. So thank you so much
So
for
true.
putting that together. That was great.
My
So
pleasure.
let me go ahead, and I'm just going to go over my information really quick, just to kind of give you guys an understanding of what I do for a living. I quit my CPA firm job over a little bit over 10 years ago to go into real estate full time, with everybody in the world freaking out, including my mother and everybody else telling me that I'm crazy for quitting a corporate job to go into real estate. But I realized I was taking control of my own financial future. And so I went to UC Santa Barbara and got my CPA license, or AKA my indoctrination degree at a higher education course. So, and then I went on to working different CPA firms, primarily on tax and audit, and working for really large or mid-sized type firms that worked on larger real estate type clients. And so, we've actually, since I quit my CPA firm job, we've actually flipped over 500 houses. We've raised over 45 million in private investor capital. We own our own private property management company and real estate brokerage as well out on the Memphis, Tennessee market. And then we also help a lot of investors with, I act a lot like a financial advisor, where I help them with the real estate taxation, understanding investments and due diligence analysis, as well as the lending and how to raise capital correctly, the property management, because we own a management company, so we understand what issues come with a property management company and what to watch out for, as well as the legal structuring with regard to owning investments and how to structure those things, self-directed retirement accounts, and setting up your team, which is really the most important part, is that team member strategy. And so what I focus on my real estate side is I flip single family homes. I buy about 5 to 10 single family homes a month. And then we also invest in value add multifamilies, promissory notes, and other outside syndications, where we pool investors' capital together for those different syndications and invest. I also run a nonprofit real estate investment club called For Investors by Investors. I run the Long Beach and the Manhattan Beach Club, and we focus on real estate and financial education with no sales pitch involved. So if you want to know more about my company, you can go to ocgproperties.com. So today we're going to talk a little bit about picking the right custodian, IRA and 401k investing structures, prohibited parties, the paperwork involved, the taxes involved, and the due diligence in managing your investments from within an IRA. So, but first, before we kind of get into that, I want to kind of go over some of the key fundamentals to drill it through your brain, because these things are really important to understand and get a good grasp on. First, all custodians are not created equal, and I'll get into the pros and cons of different custodians and on the next slide. There's multiple types of self-directed IRA accounts. You have self-directed HSAs, self-directed 401ks, IRAs, Roth IRAs, pension plans. There's every type of retirement account, for the most part, can be self-directed. And so understand that, and to understand that and different structures involved, you have to kind of get that education from a trusted advisor that understands the different accounts that can be set up and why that account should be right for you specifically. You basically self-direct it into the investments that you choose, with limited exceptions. And Karin went over some of those exceptions with life insurance and collectibles and things like that you cannot invest in, but most of the things you can invest in. There's no taxes, but you also don't get depreciation, and you can't deduct losses. So if you have a loser deal inside your IRA, you're not going to be able to get the benefit of the loss associated with that investment. Your IRA is the asset owner, not you specifically. Make sure you understand this. So on all of your documents, your IRA is signing the purchase contract. Your IRA owns the promissory note. Your IRA is that owner, not you individually. You're two completely separate entities. You can't do business with prohibited parties. As Karin mentioned, lineal descendants, parents and kids, all prohibited parties. Closely held business owners can also be prohibited parties. So be very careful about who you're doing business with. And no self-dealing. You can't buy a property from yourself. You can't sell a property to yourself. So as Karin was mentioning, with the structuring, you can set up an LLC and have a special purpose entity set up by an outside person, and then be the manager of that LLC, where you have checkbook control of that LLC and can control those investments. And what's happening is your IRA is buying shares of that LLC and has ownership of that LLC 100% or 50% if you have a partner involved, or whatever the splits are. It can't be with a disqualified party as well. You nor your IRA can get present benefit from each other. So that's what Karin was talking about when she was saying that you can't do business with people around the bout. You can't lend money to your sister and have your sister loan it to your company, because that would be getting present benefit. And your IRA can't get present benefit from you either, which is doing work on a property yourself, or managing that property yourself. Understanding your paperwork is imperative, and we'll go over some of that paperwork. Investing in your IRA does not make it less risky. You have to still do your due diligence. Just because it's in a retirement account doesn't mean it's less risk. You have to actively manage your investments. No one else is going to manage your investments for you. That doesn't mean you're the property management. That means you are managing the managers that are managing your property, or you're analyzing and making sure your promissory note payment gets paid every month. Those are the types of things that you have to manage. So those are kind of the key fundamentals that I want you to really understand, so that way you can get a good grasp of how you're investing. So let's talk about the custodians really quick. And we had a question with regard to the fee structure, which I think is a really great question and important. So there are multiple fee structures based on the custodian that you do business with. I really like using Redirect because they only have a $275 flat fee on an annual basis. So a lot of outside custodians, they'll charge you on a per asset basis. They'll also charge you based on asset values, which can really, really run up your costs involved. And so that's one of the key benefits of using Redirect, is the low fee structures involved and the proper communication with clients. And so I utilize them because of these types of benefits. And one of the questions that we got on the line was that a lot of the traditional IRA companies don't charge you these fees. However, they actually do. They just are not disclosed to you. So they are charging you fees on every transfer of that asset, every time you buy and sell any mutual fund inside the account, and they do a lot of that for you. So they make money off of the return on investment, not based on the flat fee. And so I would prefer personally to be fully disclosed. And a lot of those per asset fees in traditional retirement accounts are much higher than the traditional flat fees that you see in a self-directed account. So I believe Udirex is a $275 fee. There's other flat fee structures that can be much higher as well. So understanding those fees and the per transaction fees as well is really important. The administrative structure is also very important in understanding how fast do they get transactions processed. Do they help you resolve these problems when you don't put in your paperwork correctly, and help you to structure the deal so that it actually works correctly for your IRA and stops any prohibited party transactions? Because you want a custodian that asks those questions if they possibly can, and when they come up, so that way it helps you understand that you're doing a prohibited transaction or not, because you don't want your entire IRA becoming taxable. So very important to understand. Now, they're not obligated to share this information with you, and they don't take any liability on for sharing that information, but they try to stop you any way they can when that occurs, because it's really detrimental to have your entire IRA obviously be taxable. So the support services and the communication is really, really important, along with the quality control and understanding the safety of your funds. Is it owned by a trust company that has trust accounts set up? What types of controls are in place for these different custodians. So each one is a little bit different. Some of them in the past have gotten into trouble from doing things wrong and commingling funds. So to have that trust company set up is really important. So let's talk a little bit about the structuring, okay? So you can have a custodian and administrator actually hold the funds for you. So the custodian actually just helps with the administrative function. The administrator is actually the one that holds the funds for you and actually goes through and funds the account when a new investment comes. So you can have a self-administered 401k, which I would not recommend to anybody that is not a professional at doing this. Very important. You have major compliance issues, meaning you can control it yourself and not have a custodian administrator, but you got to comply with all the laws and regulations, all the headaches involved as well, and keep proper books and accounting. And you really don't want to have to do that, especially if you don't have very much experience doing it. It's 100% worth paying the money to do that. And even if you do your own self-directed 401k and administrate it yourself, you still have to pay legal costs for someone to update your plan documents. So, and then there's the IRA owned LLC that is what Karin was talking about, where you have your current 401k and IRA in with your custodian and administrator. You transfer the funds to a self-directed IRA custodian, and then you're buying shares of that LLC. That is that special purpose LLC where you're the manager. Now that LLC owns all the income, all the properties, or the investments, and all the income and expenses get reported right inside that LLC for tax purposes and for legal liability purposes. So there's also different ways of structuring your investment types that will help you. A lot of times joint ventures are very difficult to get done inside of a self-directed IRA because of the documents involved in a joint venture agreement and the different legal ramifications associated with joint ventures. So sometimes it's easier to hold title or own a promissory note or own shares of another entity that does unique types of structures. So that way the IRA, on the IRA, self-directed IRA level, it's a much cleaner transaction. So promissory notes, owning property, syndicated investments, and partnerships. So let's talk a little bit about prohibited parties and what not to do here, okay? So prohibited parties are lineal descendants and ascendants, business partners, closely held business partners, spouses, parents, grandchildren, and children. You can't self-deal. You can't get present benefit, and your IRA can't get present benefit. You can't provide services, and you can't have prohibited parties use your property. You can't go through and buy a vacation home and have your brother or sister live in that. And have your parents or kids live in that property. Okay, those are prohibited parties. And so, for example, your IRA purchases real estate, and then you or other disqualified persons live in the property. You or another disqualified person would be receiving a direct benefit from the use of your IRA assets, so that's prohibited. Your IRA purchases real estate, which is then rented out to an outside party at a discounted rate, okay? The outside party explicitly or implicitly agrees to provide some benefit to you or disqualified person in exchange for that discounted rent. So that specifically is disqualified because you're getting present benefit. Okay, another example. Your IRA purchases real estate, and at some later time, it lacks the funds to continue paying its mortgage or the insurance or the taxes or the maintenance involved in that property. And you or another disqualified party provide the funds to cover the deficit. You can contribute more funds to your IRA to cover those costs, but you can't personally put the funds in, or your disqualified party can't personally put the funds in, either directly or indirectly. You have personal funds to invest, but they do not meet the minimum investment amount. And so you direct your IRA to invest along with your funds in order to take advantage of that property or that opportunity. And so you are receiving a benefit from the use of your IRA assets. So unless your IRA has the ability to do the investment 100% on its own, and you have the ability to do it 100% on your own, then it's very difficult sometimes to partner with your IRA because you're each getting present benefit because neither one of you have 100% of the funds to do that investment in the first place. I hope that makes sense. These slides will be available afterwards so you guys can review these things and understand them in more detail. Also, I will be available afterwards if you have questions for me too. You or another disqualified person use your IRA assets as collateral to secure a personal loan. So you cannot get present benefit by doing that. So, and if you do this, you can make your IRA fully distributable. The IRS could actually distribute 100% of your assets. So you have to be very careful and make sure on each transaction that you do it by the book. That's all it is. So let's talk about UBIT, unrelated business income tax, and UDFI, unrelated debt financed income tax. So unrelated business income tax occurs when you're running a business inside your IRA or your 401k. So unrelated business income is income from a trade or business regularly carried on that is not substantially related to the charitable, educational, or other purpose that's the basis of the organization's exemption, okay? So I know that's really confusing, but basically you can't run a business inside your IRA or it will be taxed at typically the highest rate applicable. So it relates to the frequency of occurrence. Flipping properties, for example, can be subject to UBIT. You know, one or two here or there may be okay. It depends on your intent involved. And if you are actively working on that, that's a big problem. So, and then there are the corporate tax rates at 39%. The income associated on all the income associated with that specific business, maybe not your other investments, but that specific investment involved. So, and there's a tax return which is done on Form 990T that actually where you report this business income tax. So then you have taxes when you borrow funds, okay? So when your IRA or LLC borrows funds, then you have to pay tax on the portion that you borrowed. So if you borrowed 75% of your purchase price and your IRA put down 25, then you are taxed on 75% of that income. You can take depreciation against that 75% of that income as well, but you are taxed on it nonetheless, okay? So you are taxed on a minimal amount because of the depreciation involved there. So I have my example here of 50% loan, then 50% is attributable to the tax. However, your solo 401k is currently exempt from the UDFI, so you can borrow as much money as you want inside your solo 401k and have it be non-taxable. So let's talk about the actual property investments and what due diligence needs to be done on these, because before you invest in anything, whether it's a promissory note secured by property or if it's a property that you're owning yourself inside your IRA, you should be doing due diligence to make sure that these are covered whenever you're investing, okay? So we have the neighborhood analysis, which is very important. I personally never buy in the hood, okay? It's very, very important. You have more vandalism and theft, more tenant turnover, more bad debts from those tenants not paying. You have a lot of issues with lower end asset classes, and I've learned the hard way personally on what not to do in those situations. So you want to analyze the market value. You want to analyze the rents to understand what things rent for, and you can look at different comparables on the rental side. You want to look at the renovation, and the renovation is very important because if some people will sell you properties that don't have a lot of the things done that need to be done, some of the major systems. So we go through whenever we sell a property and we do a full inspection report with side-by-side pictures on every single thing done in that inspection report with a full disclosure checklist of all the age of all the systems in the property, showing that they should be good for at least 10 years and all the preventative maintenance done for at least 10 years on the investments that we work with. And then we manage that property afterwards for our clients too. So understanding that renovation analysis is very key so you know what major expenses might be coming up, if anything. You want to be able to understand the closing documents and review them and understand all the fees involved in those closings. Review the cash flow analysis to make sure it's up to date with your comfort level and your risk tolerance level. You know, we typically put a vacancy and repairs allowance in every single asset that we sell. Those types of things need to be put in the analysis to get an accurate return on investment analysis. So your insurance coverage, very, very important. You don't want to go with a company that does not give you full replacement cost on any kind of loss. So if you have a fire and you have depreciated value insurance, then that insurance company is only going to pay you what they say the true value of that property is, which they say if you owned it and it was fully renovated when you bought it, then in 10 years, if you have a fire, it's not fully renovated anymore, they're going to give you a percentage of what you bought it for as your insurance claim. If you have full replacement value, they will rebuild the property for you. We typically get builder grade or building code upgrades included. We get 12 months of loss of rents covered if for any peril. We get a $2 million general liability policy with dog bites covered and domestic violence covered. A lot of the little things that insurance companies exclude from the policies because they make claims. And so understanding the insurance is very important, as well as the property management. The property management is probably the most important aspect of your investment, other than buying in bad neighborhoods. And so the property management, you want to make sure that they fully understand how to run a property efficiently. So how do they do their collections? How do they do their leasing? How do they give their accounting statements? What are the different things they do to help you to mitigate the risk and communicate with you correctly? So in my opinion, the communication is some of the utmost importance, and making sure you read those contracts so you understand everything in them. Never go with a management company that is going to charge you whether it's vacant or not. Never go with a management company that's going to require you to resell the property through them if you want to sell it. So there's some major disincentives for working with certain management companies that don't work with traditional business logic. So let's talk about the investment due diligence that we do. So whenever you're investing in a property, these are the things you should be getting, whether you're working with us or working with somebody else and actually trying to buy your own assets. Get before and after rehab pictures and video. Okay, get a full inspection report from a licensed inspector that can go through that report with you and help you understand what issues exist. Get the comparable property analysis done on the rents and the market value. Do a rental analysis and profit analysis on that property so you understand how much cash flow is existing, how much appreciation to expect, how much of the loan you're paying down on an annual basis. Understand what the property tax assessor's report says, and then do the neighborhood analysis as well on these properties. Get marketing material. We go through and do a full layout of the property. We provide the comps on the rents and as well as the market value. We provide complete renovation breakdown, room by room, item by item, with that full disclosure checklist and the inspection report and a side-by-side report done. So, and then we also have our insurance agent and broker in place to help our clients with our insurance programs. And we also review the closing documents and to make sure everything is in a row and there's no mistakes. Because even title companies and escrow companies make mistakes sometimes when they're doing closing documents. So it's important to review those things, make sure you're not getting charged any extras and stuff like that. So the team members, like I mentioned, is some of the most important aspects of investing, okay? So team members are your property manager, which is the most important, and I talked about reviewing those contracts, understanding what fees they charge. Do they do markups on advertising and repairs? Are they paid if it's vacant? How much experience do they have with the laws and liabilities in those states with the tenant landlord laws? How many properties do they manage, and did they take on any more or a large chunk of properties recently, which may cause them to be inefficient? Ask them for references for investors and tenants that are happy with them. Have you reviewed their accounting statements, and do you understand them, and are you happy with those accounting statements? Research them online to see if there's any negative or positive comments about them. And how well do they communicate? Understand their communication basis so that you really understand where they're coming from. So teams of rehabbers also, I think, is really, really important when you're investing and doing renovations yourself. We go through and have multiple renovation companies working with us because as if you continually use the same contractor over and over again, then the time gets longer, the cost goes up, the quality goes down. So you want to have multiple people to go to so you can show them that you can pull the work from them if they're not performing. So very important to understand. So other team members, brokers, and bankers, different lenders, private lenders that help you with renovation projects, different affiliates, insurance agents. You want a CPA and attorney in each state you do business with because they have different laws in those states. Realtors, inspectors, selling and buying agents, appraisers, bird dogs, which is just basically people that bring you resources. So you want your A team there to actually do this. I'm, dating myself as to, my childhood shows growing up, but it really is important. Your team member will make or break your entire investment. So let's talk about managing your investments, which I think is very key. So understanding your costs first is the most important piece, okay? So mortgage payments, your taxes and insurance that may increase over time, or they could even decrease as well in some cases. So property management, is it fixed? Or is there inefficiencies involved which may cost you money? What is the typical vacancy rate that you're experiencing on the property? We have our outside management company runs over 1,500 houses, and we run over 300 ourselves, and we have under a 3% vacancy rate across the board in our properties because of the marketing system that we have in place on the leasing. Miscellaneous expenses, the repairs, the legal, advertising, move in and out costs, understanding those things and understanding when it makes sense to rent, to increase the rents on units. Managing the property manager is very key. Don't think just because you have a property management in place that your job is done. You want to manage that manager effectively and teach them how you want this thing to be managed by reviewing those statements every month, tracking the tenant collections that are due yourself as well, because you want to make sure the manager's on the ball. Okay, ask questions whenever you possibly can so you have a full understanding, and it actually helps with proper communication so that you understand why a manager is creating some certain action that a problem that exists where why do they file for eviction by the 15th of the month every time? Why do they what are their qualifications when they're leasing a property, for example? So these are the types of things, their qualifications, for example, should be they make 3 times the rent, they do a criminal and financial background check on those tenants, all of these types of things that are necessary. So, and understanding the tenant documentation that they get is important too, so you can have all the information you need. And tell them what you expect up front. That's very, very key. So review your numbers on a quarterly or annual basis so you know where you're at. Review the tax and legal implications for proper planning, and keep an eye on the market so you understand what's happening, so you can stay informed and keep your books up to date. Very, very important to understand, okay? So that being said, whenever you're trying to pick the right investment for you, you want to understand your own risk tolerance level, okay? So some people are okay with leverage. Some people want to buy all cash. Some people want promissory notes because it's less volatile versus owning a property that might have renters in and out sometimes.
I'm sure you're using Wi-Fi.
Say it again? Determining how much time you have, active versus passive investments, is also key. What return are you comfortable with? Are you aggressive and you're going to go for active returns, or would you rather slowly accumulate cash flow over time to gain that financial freedom and be more passive? Because there's a big difference between active return on investment and passive return on investment. Do you understand how you're protected on each investment? Do you have the right legal structures or insurance in place? Do you have the capabilities of using bank loans? Inside of an IRA, you have to have non-recourse financing. We finance our own self-directed IRAs to our investors as well when they buy properties from us. How much cash resources have you allocated for investment purposes? You should have a reserve on the side before you ever invest in real estate. Do you have time or other relationships that can add value in investing? what are your current cash flow goals and monthly expenses? You don't know where you're going unless you know where your starting point is. You want to develop a plan so you have a really good understanding of where you're going to be at in the future and what your goals are. Okay. So I'm going to quickly go through why work with ways to work with us. We invest in single family homes where we help investors with seller financing, bank financing, joint ventures, and cash investments or wholesale deals. And then we also have put property packages together for investors with 1031 exchanges and things like that. We invest in multifamily properties and do joint ventures and value adds on multifamilies, as well as sell multifamilies for investors that want them. We invest in promissory notes, and we have investments in promissory notes for people to invest with us. And then we deal with syndicated investments as well. And we have an affiliate program as well where investors can make a substantial amount of money working with us. So we have plenty of property acquisition choices. We have the renovation expertise, the tenanting expertise. We have proven property management in place with referrals. We do the neighborhood and market value analysis. We cash flow from day one for our investors. We mitigate all the risk and put the right systems in place. We do all the due diligence for our investors to make sure they're protected. We have the right financing options in place. We understand the state tax and tenant landlord laws in those states. And then we do help with all the property repairs and do 100% of the work and make sure all those preventative maintenance strategies are done on the investments. When an investor works with us, we typically do a 60-minute consultation to understand their financial situation and what their goals are. And then they review investment options to understand what investments might work for their risk tolerance level. And then they pick out an investment and start with the due diligence and the quality control documents, asking questions. And then we close escrow. And then we sign the contracts. Usually closing attorneys do it in the Tennessee market that I do most of my investments in. And then you repeat as many times as you can until, whether you're working with us or someone else, you want to repeat this until you're financially free and continuing to develop different cash flow streams. So what are your next steps for financial success? Develop a strategic financial plan for yourself, which is knowing where you're at right now with your current financial situation, finding ways to reduce your expenses and your taxes, which is your biggest expense, setting up the right legal structures and finding ways of increasing your income either through passive cash flow or active cash flow investments. I don't care if it's selling something on eBay, find new ways of making money. It's much easier than reducing your expenses and cutting out your cable TV and things like that, even though TV is poison anyways. But anyways, set the right financial and life goals for yourself. So you have to have a clearly defined aim. Start with your 10-year plan, work backwards to your 5-year, your 3-year, your 1-year, and your 3-month goals, your 1-month goals, and your weekly goals. Back into your or start with what your goal is and back into what activities you have to do right now to get to that level and constantly be thinking about it. And I really believe the more you get educated with financial education, the greater your success will be. It really trains your mind to think about this consistently. You write down your affirmations, you read them every day. Successful people work for assets that create money for them, whether they're working for them or not, in the long run. Okay. And I really believe the more you achieve in your life, the happier you'll become. And you have to have that desire. It's really important to have that desire and continually push forward to achieve that financial freedom and realize what the true goal is to spend time with your family, with your loved ones, and not spend time working your whole life, like a monkey in a cage or a rat in a rat race, as the pun goes for when you're dealing with, Robert Kiyosaki's cash flow game. So if you like this presentation, we have some upcoming events coming up. How to find probate deals in Long Beach on April 27th for my Phoebe group. We also have the next Phoebe South Bay event, Syndicate Your Way to Proper Diversification, on May 10th. And then as well on the next Phoebe Long Beach after that is Working with International Investors on May 25th. So you can go to meetup.com/for investors by investors or meetup.com/Phoebe South Bay to find those events. So if you're interested, you can call us and email us or fill out a client intake sheet and compile the resources you have look at your cash flow goals and the investment options and start developing a cash flow stream. And to further your education, sign up for Phoebe or actually go to Karin's Investment Club, the OCG, which actually is a highly sought out educational source as well. So we also have a networking and resources page. If you go to ocgproperties.com/en/networking, if you need resources, put your information in on what you need, and we'll try to match you with the right people that can help you. If you have resources, you can put your information in as well, and we'll try to match you with the people that actually need those services as well. So here's our contact information for Karin and myself. So if you are interested in working with us in any way, or just have questions and want to talk further, or want the slides, you can email us. My email is at mpo@ocgproperties.com. Karin's email is khall@ocgproperties.com, or I'm sorry, khall@udirectiraservices.com. So thank you guys very much for your time today. I really appreciate it. I look forward to working with you guys in the long run, and I will talk with you guys soon. Thank you guys very much for your time today. Bye-bye.